First of all, thank you everyone for joining us today for our next installment of the Summer Speaker Series. We are honored and happy to have Jeremy Schumacher and Payal Patel from Safety National and Marsh to talk about cyber today. So we'll kick this off here. My name is Eyad Kabbani, and I'll be moderating / joining in some of the conversation today. So first things first, just real quick, 2 minutes about NextGen. For those who haven't joined NextGen or have not been to any of our events, NextGen is part of the Insurance Society of Philadelphia. It's supposed to be the next generation, right? So the young professionals arm of the Insurance Society of Philadelphia, and we're dedicated to growing the network and hosting events for the Philadelphia Insurance Society. And most of all, we want to our mission is to grow our scholarship fund and help give back to the students in the insurance industry in Philadelphia specifically. So we do events throughout the whole year. The summer series is just one part of it. So if you haven't been to any of the other events, please be on the lookout and join our email list so we can get you to the next events. So a couple quick notes about the scholarship fund. You must be a student of risk management and insurance at one of the schools in Philadelphia. You have to have at least 1 year, a minimum GPA of 3.0, and exhibit extracurricular activities. What I'll say is we're always looking for new applicants, and please don't hesitate to apply. There's a lot of people who are on the board of NextGen or have that are in the Insurance Society of Philadelphia that have benefited from this scholarship. So if you are a student and you're currently enrolled in a risk management program, please do not hesitate to apply. Professional grants. So if you're not a student and you are looking to do a CPCU or an MBA or an ARM and your company won't pay for it, we also do give out professional grants. We get a little bit less applications for these. So for those who are young professionals in the early parts of their career looking to better themselves, please apply. You need a minimum of 3 years of working, but this is a very good opportunity for those looking to better themselves. So before I introduce Payal, just one more housekeeping item. There is closed captioning for this Zoom, so you can find it by clicking in the bottom bar there. There should be a closed caption button. If you have any questions or need anything, Sarah is on the line. She's listed as ISOP HQ host. Please feel free to just message her and she will help you get sorted. So today we're going to be talking about hot topics and cyber overall. And so we're going to keep this as more of a discussion and kind of a free-flowing conversation. If you have any questions or there's something you don't understand, please feel free to just come off mute, ask a question, or put it in the chat. Payal, myself, and Jeremy all work in the cyber insurance industry. And so we understand that it's very niche, very specialized. Not everybody knows everything about what we're talking about. So if you have any questions, please feel free to stop us here. So first, I'll introduce Payal. She's Senior Vice President and Northeast Zone Cyber Practice Leader. Payal, I'll pass the mic over to you if you want to just give us a brief introduction about yourself, your name, company, how long you've been in the industry, and how you got into the cyber part of the insurance industry. You're on mute. There you go.
Yes, sure. And thanks for the introduction. I appreciate it. And welcome, everyone. It's great to be here with you. Appreciate your attentiveness today. And you're wanting to learn more about the cyber industry. I have been in the insurance industry for 11 years, at Marsh for about 7 years. And prior to that, I was at Aon. I actually, like probably most of you, went to school for risk management and insurance. I'm a proud Temple graduate, which I'm sure some of you on the line are as well. In terms of how I got into cyber, I think everybody says that they typically fall into insurance. I feel like I fell into cyber, networked my way in. I started as an account representative in the DC office for Aon, had a lot of experts and professionals come in to talk about cyber with our clients and prospect cyber, and fell in that way by having some conversations, seeking out some opportunities to work within the industry, and then moved to New York and became a cyber broker and never really looked back. So that's a little bit about me.
Thank you, Payal. Jeremy, Jeremy Schumacher is the Director of Cyber Underwriting at Safety National. Jeremy, I'll pass the mic over to you.
Yeah, the tenure and length of stays kind of oddly match up with Payal. Been in the industry since 2010, so 12 years, and been with my current company, Safety National, for 7. So I went to law school with the intention of being an attorney, something that I'd planned on through undergrad, and in law school decided that is not really what I wanted to do. Did not enjoy it as much as I thought I would. Did enjoy contractual law and that side of things. So actually, when I first graduated, I got into commercial real estate. With hindsight, getting into the real estate market in 2008 was not the best time to attempt that. So after a couple of years stints doing commercial real estate, I moved over to insurance. That's kind of oddly enough family business with various members of my family involved in commercial insurance in different capacities. Actually going back to my great grandfather. So not anything that was ever of interest, though I heard about it at the dinner table every night. So, it was one of those things that was kind of an obvious segue when I was trying to decide next path, I guess. So that was, again, 2010, started with Allianz as an inland marine underwriter. So I have, various stops along the way, but inland marine, doing motor truck cargo, builder's risk, property, contractors, equipment. From there, I moved over to Hartford, doing middle market as a technology and life science underwriter. So focused specifically on tech and life science risks, comp, auto, GL, umbrella, international, and some tech E&O. So that tech E&O is kind of the first step in towards the cyberspace that I had there. From Hartford, came over to Safety National, and initially that was in a large casualty role, focused on large risk management size accounts, comp, auto, GL. And when Safety decided to pursue and build out a cyber practice group in 2017, I asked to have some role in that, and kind of quickly morphed into being part of a small cyber team started by Spencer Timmel, who we brought in to lead the cyber practice group. So been underwriting cyber since 2017. Again, kind of touching back with that E&O experience I had as a middle market life science underwriter.
That's awesome. I think maybe with the exception of the Greenbergs, you're probably one of the only people that can date back to their great grandfather working in insurance.
It's pretty. Actually, my dad knows there's some old rate books hanging out there. I mean, he used to be like a traveling salesman, and would write a policy on foot out there. I'd love to get my hands on them, but it would be awesome.
Business was done very, very differently back then. Very differently.
Yes.
Awesome. Thank you. Well, we appreciate you taking the time today, Jeremy. It's an interesting way to get into cyber. So I'm looking forward to this discussion here.
I appreciate the opportunity.
Really just kind of want to level set here and talk quickly about the hard market. And for those who don't know, I mean, I think it's been all over the headlines. Cyber has gone through the most difficult hard market it's ever seen in the past couple of years. And so I know we have some varying levels of experience on the line and some who don't touch cyber at all. So I guess, Payal, I'll flip this to you. Can you just quickly talk about what caused the hard market and given your experience just talk about, first of all, what is a hard market and what has caused it over the past 2 to 3 years?
Yeah, simply put, I think it's just a supply and demand curve.
Yeah.
Right. So when supply is low and demand is high, you end up in a hard market. When supply is robust and demand is low, you have a soft market. So it's either the buyer of insurance has leverage in the negotiating seat, or the actual product, the insurer, has leverage in the negotiating seat. And I think cyber is pretty immature as a product in itself. Like Jeremy was talking about his past and some of the lines of business that, he had experience in, and some of those lines of business have been around for hundreds of years, whereas cyber has probably only been around for the last 25 years and relevant for probably the last 15. And it started out as pretty much a privacy product, and everybody was very concentrated on how data was collected, data was managed, and if there was a privacy breach, what elements would the client have to pay in order to protect their own reputation, and what liabilities would they have to third parties. And it evolved more and more into a product that really covered operational technology risk, which is simply, you use technology day in and day out to run your business. If everybody opened their laptop tomorrow and didn't necessarily have access to your drives or your emails or your client files or anything that you need to actually operate, it would be pretty challenging to operate. And so cyber evolved into covering those types of risk in the event that a bad actor infiltrated the systems, demanded a sum of money in order for you to have access to critical data. And as we rely on technology, our reliance on intangible assets also increases. And the pandemic has even moved that forward even faster, right? Everybody was working from home overnight. You had to open your laptop in order to be productive for your company. And so the reliance on intangible assets increased. Yet from a security standpoint, I would say a lot of the companies that are using this technology don't necessarily elevate the types of controls, the types of tools they're using, and make sure that they have, at a minimum, the correct security posture to protect those intangible assets. We look at property and we think sprinklers, or, you look at even your car and you have like certain brakes or precautions or even airbags in the event that there's an accident. But when it comes to cyber, a lot of the doors were open and a lot of the clients didn't necessarily do what they needed to do to protect the intangible assets. So there had to be a lot of education in terms of what was needed in order to actually get insurance, because the insurance policies were being used frequently and the claims were becoming more and more severe, and they were impacting all industries and all sizes of clients. And during a hard market, obviously, especially after 15 years of telling clients great news about their cyber renewal, saying that premiums have reduced, saying that limits have increased, to establish a message that is more negative in terms of, because we didn't have the right controls, we actually weren't able to obtain the premium that, you desired, or we weren't actually able to obtain any capacity, or we were able to obtain limit and capacity, but we had to substantially cut coverage. Those were really challenging messages that we had to deliver to clients. And the only way to really deliver those types of messages is to back it up with data, to back it up with education in terms of the types of tools that they would need to improve the results, and to honestly support the markets that have been paying the claims. I think the last thing I would say is cyber, unlike any other industry class, is very interconnected. So we use Amazon Web Services, and we use Google Cloud, and we use Microsoft, and we use all these other technology companies in order to run our own businesses. And unlike any other industry class, you cannot isolate the risk. And that is something that our industry is working more and more towards figuring out how to properly underwrite, how to properly price, and what questions to ask, and what the product should actually cover. Because in a world where you cannot isolate the risk, it is very hard to price and it's very hard to control how the policy is actually going to be applied in the event the client has a security issue.
I appreciate that. Thank you, Payal. Jeremy, from the carrier perspective, right? I think, my experience is I joined in January of 2021, right before the market really kind of fell out, right? And I look back at some of these policies and they're being written for $2,000-$3,000 a million, just numbers that are not sustainable. So would love for you to touch on, from the carrier side, why do you feel like we got into the hard market, and what were some of the mistakes that the market had made prior to going into 2021 or 2019 and 2021 and stuff like that?
Yeah.
What you did to manage that?
Very on point in terms of the pricing. I mean, it came down to inadequate pricing for the coverage that was being extended at the time, and the risk involved, which all traces back to, as Payal said, I mean, the newness of the industry, the lack of the data, the constantly changing threat landscape that's evolving, daily, nightly out there, and in some ways is almost impossible to fully get your arms around it, and is definitely way different than a property, a comp, an auto policy, where you have years of historical data. But exactly on point. I mean, 2017, that's when I started underwriting in the industry, and 2,000 per mil, 3,000 per mil, you would see stuff like that. I mean, stuff that we're not going to touch. Our minimum premium is going to be 10 times that at this point per mil. But that led to when when there was a dramatic shift in the threat landscape from it, as was stated, a target type loss where that breach was all about the third party loss of records data to first party ransomware losses that started to creep in around 2019, 2020. Your industry loss ratios went from 35% in 2017, 18. It started to see a creep up in 19 to 47%, I think. And 2020 is where you see the major pop up to 75%. And that's where action had to be taken, and markets across the board started to shift. And that's, that was the start of the hard market. So, from the carrier side, the insurer side of things, hard markets are nice in some ways. Obviously, there's the negativity in the numbers behind the scenes that's pushing that. So it's never a good thing when you're running a hot loss ratio and your combined is over 100%. But on the flip side, in terms of your pricing and your renewal terms, the power is back in the seat on the underwriting side, and the ability to push price and name your price is a nice thing. You do need to obviously be very careful because there's relationships. The market can shift very quickly, and just because you're the one wielding the sword right now doesn't mean that you want to just go flailing it all about, because it's not going to end well in the future when you lose the sword and the market shifts as it always regularly does at some point in time. So yeah, I mean, from a pricing perspective, the pricing wasn't there. The threat landscape shifted. Ransomware became the main threat, and what those losses look like was not something that was foreseen within the industry, leading to these high loss ratios. So when you're sitting at a 75% loss ratio, what should be kept in mind is that's your loss ratio. That's not your combined ratio. I think average expense ratios mid 30s, 35, 36%. So you tack on 36% expense onto a 75% loss ratio that some might be running, and your book's real ugly real quick, and that came out of nowhere.
I appreciate that, Jeremy. Just real quick, for those who are on the line who might just be starting their career, a loss ratio, anything over 100% means the company's not profitable. Anything below 100% means that they were profitable, but obviously 99% is probably not successful, right? You got to shoot for, Jeremy can probably touch on what a good loss ratio is, or what a good combined ratio is, but from what I've heard, it's low 90s, maybe in the 80s is a good combined ratio.
Exactly. Yeah. And it's very dependent on the line of business as well, in terms of how quickly that's paid out. So you can have some a line of business such as comp where your payouts may be extended. Mm-hmm. And because of that, you can run closer to or even over 100% combined if your investment income is there. Yeah. But that's not historically how cyber has necessarily seen. I mean, you need to pay the expenses to get the insured back in place and up and running fairly quickly. A lot of times, will you see a longer tail on some regulatory fines, expenses, class actions? Yes, but you're going to need to keep that combined under 100.
So, Jeremy, it might be a little bit premature, but I guess let me ask you this: we're seeing it on our side. The market is starting to soften a little bit. Have you found that the adjustment, is what I really like to call it, right? It was really just kind of moving the minimum bar up in the past year and a half. Do you find that it's been successful for you to manage your book of business? Maybe not, you don't speak specifically about City National, but in general,
Yeah, I think overall the industry is seeing the loss ratio come down. I mean, nobody's 100% forthright and just putting that out there mid-year, but the anecdotal evidence and what you're hearing at conferences talking to folks is, ransomware events are down right now. The loss ratios are coming back a bit under control. As you mentioned, it seems like the market, though definitely not a soft market, maybe softening from the highs of Q4 2021 and the pricing pressure that was seen there. So, I know a question that was asked was something about, what did you see in the hard market? And thinking that through in advance, I wanted to point, I'm like, well, did makes it sound like it was over and in the past. And I hope that's not what we're saying, because there definitely is still a need to advance that pricing. But I know that it's going to be impossible from that broker side to continue to sell. You can't sell 100% increase 2 years in a row. It's not sustainable. And especially on many of these risks that haven't taken a loss. So I mean, if you have a risk that hasn't taken a loss, and you just point to the fact that it's a pooling of risk, and this is what the industry is doing right now, and we get your controls are in place, but the market wants another 100% this year, that's impossible. So because of the lumps taken towards the end of last year, I think it's starting to soften a bit for sure. And folks have started to turn their books from what we've heard. Safety in particular, we were lucky. 2017, starting out, yes, it was a softer market. Pricing was low, but we were also a completely new entrant. So we did not have a lot of mispriced legacy book of business that we needed to turn, which definitely made this market easier for us and presented a real growth opportunity.
Love to hear that. Thank you, Jeremy. So real quick, so we'll shift to the next topic. I think I didn't put this in the email to you both, but I think it's a relatively easy topic and a bit of a hot topic as well. You mentioned Safety National was a new entrant in 2017. We're seeing a lot of new entrants in the market this year and kind of towards the end of last year, really insurtechs and MGAs. And so, Payal, I really want to see from your perspective as a broker, can you talk about how these new entrants have changed the market and some of the issues that you need to consider when placing new business with some of these insurtechs and these MGAs? I think, it's not a Chubb, it's not an AIG, it's not the Beasleys of the world. So would love to hear your thoughts on that.
Yeah, just for the group, MGA is a managing general agent. So you basically have supporting capacity that's actually taking on the risk, but the MGA has the pen to make claims decisions and to make underwriting decisions on behalf of the insurer. So not all MGAs are equal. It really depends on the capacity that's supporting them. We've seen MGAs come in and out and be inconsistent. We have seen other MGAs be very consistent and also hire very strong leadership that has been in the market in other direct insurance carriers as well. So in terms of the MGAs, I would say the first thing I would say is not all are equal. But the second thing I would say is that they really filled a need when we needed it most. A lot of the MGAs took on risks that we weren't able to get covered by the direct insurance market. Some of them were more competitive, especially for clients that weren't able to spend the premium that the direct insurance market was looking for. And I know that the direct insurance market has challenges with some of the MGAs because they don't share the same loss pool that the direct insurance market had, which is why those premiums have increased. But they have helped our clients drive a lot more optionality across the market and get coverage in some cases when the direct insurance market wasn't able to support a risk. So from an MGA standpoint, I think it just depends on who it is and what service offerings they're providing to the client. When we talk about insurtechs, it's because the way this industry is going, technology and technology companies really need to step it up and be a part of the solution when it comes to driving better security for our clients. And a lot of our clients, for example, are moving to cloud, and a lot of our clients are investing in these controls. And the insurtech strategy is to help clients understand where they are right now in terms of security controls, where they need to be, and either provide those tools, provide a discount to obtain those tools, or introduce them to security vendors that can help them improve their risk posture. And at the end of the day, that has got to single-handedly be the most important part of this process. If our clients continue to invest in security controls and become better risks, then the market will be able to underwrite and provide options that truly differentiate you if you are doing the right things versus if you are not investing at all. And that's something that's challenging within cyber because every CISO, Chief Information Security Officer, every single year will have a top 10 or top 20 priority list, and they better be ripping it up and creating a new top 10 or top 20 priority list for the next year, to Jeremy's point, because the threat landscape keeps changing and because the technology that they are using to enhance their business processes also require a different footprint in terms of the security controls and investments that they need to keep up.
Appreciate that, Payal. And Jeremy, I know Safety National is part of the Tokyo Marine Group. You guys are an established, respected, and most importantly, a financially stable insurance company. So I guess the question for you is, when you see these new entrants and you're competing against them or having to sit above them, what are your concerns from a carrier perspective, if any? I know some carriers don't care and some carriers do. So what are your thoughts?
Yeah, it's interesting. To your point, some carriers, do look at the financial standing of other markets on a risk, and from our perspective, that's nothing that has come into play yet. Just kind of a flip from your question that I think should be touched on and was mentioned a little bit is I think these new entrants do definitely have something to offer the overall industry, though as competitors of ours. There's different ways of examining a risk and looking at a risk, and a lot of the historical legacy way of doing that across your commercial lines is based on your kind of firmographic data, based on the payroll, based on the sales for GL. That's your exposure base. That's how I'm going to rate your account. I have standard rating basis based on your industry that I'm going to place on that, and this is somewhere in the range of where I'm going to price the risk. That was, in the early stages of cyber, kind of the known way to do it. What's your sales? What are your sales? And I'm going to rate this off of sales based off of your industry, and also ask you some questions. That in my mind is not a sustainable long-term way of pricing cyber. And I think that's what a lot of these new entrants have identified and are offering, as far as they're going to be running a lot of external scans, and they're going to be looking at other ways to identify you as a good or a bad risk and price it up. And that to me is where the industry, the cyber industry specifically, needs to shift long-term. Pricing and valuing a risk simply based on some numerical data points doesn't get a true understanding of the quality of that risk. Obviously, on top of that, you can ask questions and understand controls. But inevitably, what happens in the event of a loss is something that the loss stems from something that was not a known hole in the risk, not a known default. So, we asked the question, or the application noted, did you have MFA in place? Yes, we have MFA in place. Well, guess what? It was this one segment of the company, this one new entity that they purchased that did not have MFA in place that resulted in the breach. And those are the kind of things that eventually, hopefully, via scans, and gosh, if you could get to the point that you have internal scanning allowed and opened up, that you can spot stuff. So, a property risk, loss control is allowed to go on site and look inside the building. You tell me it's sprinklered, and you have sprinklers in your building, and that's the control I want to see on this type of property risk. Well, you're also allowing me to go in the building, and I can, pressure test that system, and I can see the number of heads, and I can make sure that they're, not blocked inside of a drop ceiling. We're not at that point in cyber. There's not an obvious level of comfort to allow folks inside the network, but at least that external scanning is something that's really necessary in my mind to truly mature the industry and the pricing there.
That's an interesting topic. I think, Payal and I, we've, over the past year and a half, the number of questions that we've gotten from the markets and we've had to present to our clients has just increased, tenfold, if not more than that. And so some of these clients are like, I don't want to share these answers. They're like the keys to the kingdom. So the thought of having to ask one of our, marquee clients, hey, Safety National or AIG wants to come in and examine your systems. I don't know if we'll ever get there, but it's an interesting thought.
That's definitely a heavy push. That's a long-term goal. But yeah, even just the the external scanning and aspect that again, a lot of these insurtechs are bringing in and bringing to the forefront. When you look at not just valuation, but written premium that Coalition and some of these folks are bringing to the table, it's I think it's proven it's sustainable. They're on to something. It can't be ignored. It's not a non-factor in the industry.
Agreed. Thank you for that. So in the interest of time, we'll switch to the next topic. So really just kind of want to talk about systemic risk and zero-day vulnerabilities. And first of all, what it is. I'll give a brief overview of it. So for those who are on the line who are not in cyber, there's this concept that's been going around for the past year and a half. I mean, and more than that, honestly, but it's really come to fruition in the past year and a half, is really kind of a systemic loss or systemic risk. So some type of threat that poses a catastrophic threat to an insurer's like total book of business, right? So an aggregation exposure due to a systemic loss. So when you think about like common vulnerabilities like Log4j, SolarWinds, Acelion, Microsoft Exchange, right? These events that, to put it in layman's terms, right? Like that it's software that's used across, kind of the whole internet, and all these companies use it. And if there's some vulnerability, thousands of clients of Chubb or AIG or whoever may be, or Safety National could be affected, and there could be a catastrophic loss that would affect the whole book of business, right? So what has happened is that, some carriers like Chubb, AIG, and I think, Beasley's working on it, is they're starting to put these systemic risk exclusions or shifting the way that their policy form works so that something that is that catastrophic in nature and that widespread, to use Chubb's terms, is not going to be covered, or there's discretion for it for the carrier to decide. It's something that's been a little bit controversial in the past year and a half. As a broker, we try not to place business on those forms if we don't have to. As long as there's a competitive option in the market, then we choose that. Jeremy, if I'm not mistaken, Safety National has not been a carrier that has implemented that kind of systemic risk concept. I guess the question for you is being an underwriter and facing these risks, they're very real risks. How do you underwrite to that? How do you try and understand that and wrap your head around it? Love to hear your thoughts on that.
Yeah, definitely. So, I mean, a few different things here. I guess first being, we are Safety National is truly focused on writing excess cyber right now. So in terms of forms, language, coverage, we are follow form based on the primary, and what those leading primary market players, the AIG, the Beasleys, et cetera, out there are doing is what we end up following, from a comfort level on the excess side. That being said, from systemic risk, really at this point in time, the main thing we're doing is trying to be mindful of known security flaws. And that's kind of the hard thing. There's the systemic risk as far as known risk that we have figured out, like you said, the Log4j, Microsoft Exchange, Acelion. You can ask those questions and you can confirm that they're patched in regards to that. But then there's the unknown, what's the next Log4j out there, et cetera. And how do you in any way, try to underwrite and protect against that? At this point in time, again, I think the industry is still a bit too young to try to find a way to underwrite around that kind of stuff. So it's pure exclusionary language, or at this point, I think it's gathering and trying to use the data set you have to understand what your aggregation going to look like in multiple different scenarios that actuary may be able to run through. So, how many AWS users do you have out there? From a healthcare perspective, how many are reliant on Cerner for their electronic medical records? Trying to get a handle on that to understand from an aggregation standpoint, in the event of a loss that hits a specific area, what that may mean to you. Beyond that, the pure underwriting, asking questions of known issues to try to understand the controls in place is really where we're at.
Appreciate that. And Payal, from your perspective, can you just give a quick touch on like how your clients have taken to the systemic risk approach and what you've seen happen to the markets that have taken this approach in the past year and a half? I mean, it's been a hard market, but there's still been some competition. So I would love your insight on that.
It's a challenging question. And it's something that I feel like if I could answer today, I'd be queen of this industry. Like anybody that can answer this question, like would rule cyber. We consistently ask clients questions in an application that pertain to their own security. And we consistently provide coverage for clients that protects third-party vendors. Like everybody on this call should know that cyber is much broader in terms of coverage, and the questions we asked do not all correlate to the coverage that is provided, which is why it's so valuable to clients. Now, in terms of the strategy, you have different insurers that have different appetites, right? So that could be one. You would have someone that may look at Cerner and want to be on that risk, and others that may look at, healthcare and EHR record keepers as someone that they don't necessarily want to insure. You also have the retentions and waiting periods and limits. And to your point, our job as representatives of our client are certainly to show options. It is also to drive a sustainable insurance market. And so even though we may not agree with the Chubb systemic risk concept, I do think they're onto something in terms of making sure that there is a certain bifurcation around the elements of the policy that they underwrote to and the elements that they didn't underwrite to, but you still are exposed to and they still want to provide coverage for. Beasley is providing their new systemic risk strategy in Q4 as well. None of the wording is consistent. I think, again, it takes a lot of merging with the tech industry to really understand conceptually the things that we are providing clients coverage for and the impacts that a cloud outage could have and the reality of a cloud outage. Because to my knowledge and all the security conversations I've had, I feel like every security professional is will double down on cloud versus any sort of on-premises type of way to secure, capture, or process data. So I do think as an industry, from a tech standpoint, we definitely need to be more integrated. And from a coverage standpoint, even though it is extremely broad today, it will shift in the future, whether that means naming suppliers, whether that means increasing waiting hours periods, whether that means parametric solutions. I don't know, but it's up to you guys to come up with that solution and then be the king or queen of cyber.
Yeah, we have some, there's got to be some wizard on this call right now that there's going to be CEO in like 10 years. So we'll see. No, it's
just remember us when that happens.
Yeah,
Bring
please.
us along. I'm happy to ride coattails.
No, it's interesting, right? I think, this is why cyber is one of the more, I don't want to say one of the more, is an interesting part of the insurance industry, right? So when you look at like a property policy or comp policy, they've relatively been the same over the past, 100 years or so. Cyber is an evolving product. And so this is part of the evolution. And it's interesting to see how the product's just changing in real time. So we'll move on to the next subject here. Really just want to talk about, be remiss not to talk about war and cyber war and the fun topic that everybody, they're kind of, hot words that everybody likes to say. So, to this day, the war exclusion has not been used to deny any coverage. It's really been a hot topic in 2022. Payal, would love to hear, I've been in the trenches with you, so I know what it's like, but as a cyber broker, how have you dealt with the inconsistencies across the market around the war exclusion? And then Jeremy, will shift to you on your side. Would love to hear your thoughts on an excess basis.
Yeah, I think it's important for the group to know that this policy covers non-physical perils. It does not cover physical perils. So when we talk about a war exclusion, that's something that you see across multiple sets of policies. And the difference in cyber is that you start to see what's called a cyber terrorism carve-back. And that has caused a lot of pain, angst, and inconsistent responses across the insurance industry in terms of what they're willing to accept, the breadth of that type of carve-back, and how it should apply. And there is still not consistency across the insurance industry over that. In fact, Lloyd's had released guidance and 4 types of language around the war and cyber terrorism language released last November. And some of the insurance carriers right now are adopting that, negotiating that, or trying to apply it across their book of business. Depending on the industry class that you are servicing, it could be a challenge. For example, defense contractors, they are arguably in the business of war. So depending on how tight that exclusion is, they may have a challenge with it, whether that's for their E&O or cyber coverage. All I can say is that the insurers are the ones that need to prove attribution when it comes to war. So when it comes to the what cyber is covering, we are covering security attacks, privacy events, business interruption losses, all non-physical perils. And sometimes there are alleged attacks from one country to another. And it is definitely on the insurer to prove attribution in order to apply the war exclusion in a policy. And how that is going to be defined across the board and consistently defined is still a question. And if you ask each insurer, including Safety National and Brit and AIG and Chubb, they will have 4 different responses. In terms of setting a program for a client, just in general, you always want to avoid non-concurrencies when possible, because when you are evaluating a claim situation, those non-concurrencies, if that exclusion is brought up in a debate to pay or not pay, will be evaluated differently per layer. And as the words change, they will be carefully evaluated per layer, and they may make or break a claims discussion for you, for a client. And so Marsh's position is, we try to agree on 1 war exclusion and 1 cyber terrorism carveback per program. And even if it is narrower in a certain excess carrier, it's probably better to have consistency in language versus inconsistency. Because even sometimes when you have the broad language in a policy, that insurer may not interpret those words in that way. So it is a gamble right now when you have inconsistency of language. It is a gamble to even take the approach to have a narrower set of language. But I think the insurance industry needs to come together to have an agreement on what we constitute as war and where we constitute that break in terms of what we're willing to cover for cyber terrorism and what we're not willing to cover. The LMA wording, I think, is a little bit better. The Munich Re agreed wording is a little bit better in terms of just trying to classify if there is some sort of systemic risk across a nation that impacts the majority of the financial systems, and that nation or that country is not able to actually sustain itself. That's when they will start to teeter on the line of what war is. But that's the first time that we've seen that type of line drawn in the sand in terms of claims that would constitute war or cyber terrorism.
Appreciate that, Payal. Obviously a loaded topic here. Jeremy, on your side, right? I mean, you're an excess carrier, and you get to look down some of these towers and see, just in some cases, lots of inconsistencies across these war exclusions. Being, an excess carrier, I guess, what would your thoughts be on how some of these carriers can do it better or better address this risk? I mean, it's not exactly an easy thing, and I know it's not an easy answer there, but would love to hear your thoughts on it.
Yeah, no, I mean, Payal nailed it in terms of the fact that there are, different exclusions. Really, every carrier has their own. I think, right now, if we're looking for the easiest answer is one of those 4 or a combination of those 4 Lloyd's offered exclusions would be what need to be looked at. You don't always need to have a single exclusion that's used across the industry, because in different circumstances, different levels of coverage based on the breadth of the exclusion can be utilized. So, I mean, similar to GL with pollution exclusions, there are different levels of carvebacks within those exclusions, and I think cyber could settle on a similar set of 2, 3, 4 exclusions that could be utilized. But bringing commonality to it is really a must. I mean, when you have something as vague as war, what is war right now? I mean, that's difficult. Espionage has always existed. That's existed for a long time. But I don't know. We can blame Al Gore for inventing the internet here and taking this to a whole nother level. But war stemming across internet across countries, and the attribution of it becomes very difficult. Especially when you're dealing with a country like Russia and an organization, still, not that they're good people, but one of the coolest names, Evil Corp. I mean, legit, one of the largest hacker groups out there that's funded themselves 100 million times over with malware. But you have an organization like Evil Corp in Russia that it's not Russia. They're not the KGB or any offshoot of that. But they're causing a lot of havoc, and they're not they're not receiving any pushback from the Russian government. There's pictures and videos of these guys doing burnouts in Red Square in their Lamborghini, stuff that nobody else is going to be allowed to do unless you have connections and people know who you are. So when they're involved in stuff and they have the backing of the Russian government, is that war? Well, so far, no. I mean, you don't have that attribution. That stuff has not been found to be pinned back on a certain country, I guess. So that's where you can't exclude everything. You can't draw a box around every problem where you're not actually providing any solution to the insured. So you have to be careful in that regard. But some standard language should be settled on. And again, I think at this point in time, Lloyd's carries enough weight within the marketplace, the cyber marketplace for sure. They've offered some solid solutions, and if the market could lean on those, would be a best solution at this point.
Appreciate that perspective. One thing I hear when we talk about all these things is it's the answer in insurance is always it depends, right? Or it's everything is always gray. There's never black and white. There's always something to it. So for those just getting started, just know that it depends. That's always the answer in insurance. So we'll quickly move through the next topic, and then we'll wrap up with some unsolicited career advice. I'll pause here. Anybody have any questions or anything? If so, please feel free to just put them in the chat. We obviously want this to be interactive. Give it a second here. If not, we'll just keep moving. All right, we'll keep it moving. If you have any questions, put them in the chat. So, regulation is the next topic, and we'll keep this one kind of quick. Because ransomware has really been the hot topic from 2019 to 2021. Before it was really, these large breaches like Target and Home Depot and all these, Equifax, those were really the headlines. And now it's been ransomware, Colonial Pipeline, JBS, the whole nine. It's still certainly the biggest concern. I think probably one of, maybe not the easiest one to underwrite to, but I think the cyber market has really become more technical than they've ever been, right? I think 10 years ago, you could fill out a renewal app, not answer too many questions, and you'll get a renewal. Now it's like 600 questions, and they want to know the intricacies of your network. So with regards to regulation, as the environment intensifies, how do you see, this is Jeremy, it's for you, how do you see the cyber insurance industry adapting and changing? And what do you feel like this is the next threat for the cyber insurance industry? I don't want to call it a threat. I think it's something to consider, I guess. Yeah, no, definitely consideration. Again, I mean, this one to me is a bit easier than other threats, in the fact that the regulations are known, the necessary controls around them are known. That question set is typically a bit easier. But to your point, it is something that is becoming more prevalent now. And I think it's just, to me, it's because of the reactionary nature of regulatory environment. So you have, the data breaches and loss of personal information that was occurring in early 2000s, early teens, Target in 2013, Home Depot, those were the large ones, which started to lead to, governments, legislatures deciding that we need to put controls and give people control of their personal information and limit the use of that to an extent. So that's where, GDPR was 2018, CCPA in California, 2020, predating that, a bit odd, honestly, BIPA was 2008, but BIPA really has started to gain teeth, being the Illinois law in the past 2 or 3 years, where the private right of action that's been provided to individuals has led to a lot of lawsuits and class actions. And so BIPA, again, even though kind of predating that, it's really the case law over the past 2 or 3 years that started to creep up that's made that more of a talking point and brought it to the forefront for anybody that has Illinois employees, customers, et cetera, something to be mindful of. So, the regulatory, again, I think it is something that is necessary to be mindful of going forward. It's a bit easier in my mind to get our arms around the necessary controls there, because we understand what the triggers are for a loss. It's written, it's on paper. Yeah. And so those should be complied with and should hopefully in most circumstances be pretty easy. I'm not saying easy, nothing's easy when it comes to security control, but more of a yes, no in a lot of circumstances. BIPA's the big thing is biometric information. Yeah. So do you collect it? Yes or no? If you do, have you, in all circumstances, obtained written consent in advance of collecting that biometric information? Some carriers just slap an exclusion on and they just say that's their solution. So this is true. Safety National is not one of them. We'll say that. Yeah. Safety National is not one of them. So we'll
Thank you. Appreciate that.
Pyle, I guess really BIPA is kind of the hot topic. It's been, but how have you helped your clients manage that risk and work, and how have you seen them kind of manage the risk with regards to the regulatory environment and all that?
I mean, it's really what Jeremy said, right? It's like obtaining that written consent and then this actually applies from 3 years before. And I think that's what trips up a lot of our clients. This is really like a challenge in terms of the industry, I would say, because privacy is making a comeback in a different way. This is no longer about breaches. This is about how organizations protect the data when they disclose it, how they collect it when they destroy it. And in the US, if these laws continue to change this way, and if the fines or penalties continue to increase, or if you have other states that allow for private rights of action, on the insurance side, you're going to see a lot more liability lawsuits. And you're going to see a lot more defense expenses paid by our insurers. So from an insurance perspective, it's the big debate is this a business practice issue or is this an insurable issue? Mm-hmm. But from a client perspective, I think it's more about what Jeremy said in terms of following the law, and the retroactive piece is, I think, what trips up our clients the most.
Yeah, and that's the interesting thing on our end. I'll just throw in real quick in the fact that retroactive nature we found and kind of got tripped up in a couple instances for losses where, the question being, do you comply with BIPA? Well, it's not just do you comply, it's did you, have you always complied because of that 5-year look back? With the other piece being what is biometric. When you ask that question, a lot of these insurance think, Mission Impossible, iris facial scanning. No, we don't do that. Access to the server room, it's just a card and you're in. But what we've seen in terms of claims and losses are retailers and some in the industry that have apps where you want to see yourself in our clothes, you want to see yourself in our makeup, our jewelry. Well, take a picture of yourself from multiple different angles. We can upload your body into the system and you can see yourself in this stuff. Well, all those different scans and images, that's biometric information right there. And that's something that's not what somebody initially thinks of a lot of times when you ask, do you obtain biometric information?
Now, yeah, I would argue I would argue against that. Pyle knows why I'm saying that. But it's up for debate. But yes, no, I agree with you. Is that in that people think they kind of have a box around what biometric information is, and there's way more to it than just what they think. But it's funny. We had a client, very similar situation. They had an app, and it they argued it's not biometric information. Someone argued that it was. So it's the whole thing.
Yeah. Either way, there's fees and expenses to get.
Yes,
to the end.
Exactly. There's lawyers making money off all of it.
Yep.
So, all right, with that, we have 5 minutes left. We appreciate both of you guys for hopping on this call and talking through all the fun parts of cyber today. Like to end it on a bit of an easier note and provide some unsolicited career advice. I mean, you two are both very successful and still climbing the ladders in your careers. So, Jeremy, we'll start with you. If you had to give, if you were in our shoes and some of the early career professionals' shoes at this point, what would be a piece of advice you wish you knew when you were early in your career, or you would give to some of these professionals?
Yeah, so just two quick ones. First, I mean, I think as can be seen based on my career path, it would be open to change. I mean, I've been involved in multiple different parts of the insurance industry, underwritten multiple lines of business, and I think it all adds value. And at some point you'll decide what you like the most, and you'll land in the right spot. It'll work out. But if opportunities present themselves to learn something new, take that. The other one would be to try. So it's kind of as dumb as that sounds. I remember being young, and when you're trying something new or trying to learn something new, it's really easy to just give up. And my dad getting frustrated, just try this thing. And I'd say where that comes into play is when you're learning something new within the industry, underwriting, whatever it is, it's really easy to say, I don't know the answer. I got to go ask somebody for the answer. I think what's frustrating and what for that individual, somebody asking them a question, and what can set you apart is when you come with some possible solutions. Don't just show up to your boss's office and say, I don't know how to do this. I don't know, what would you do here? talk about, here's what I think. I'm probably wrong. I'm very confused here, but here are a couple things that I think might work out, or here's how I might want to do this, because that shows the effort, that shows you trying to work through the problem and offer a solution, and does a lot more, again, than just, showing up as a clueless individual who needs help. That's not what anybody wants to see, and really leads to growth when you're putting yourself out there and trying new things.
So Google it before you ask a question. Google it.
That's too easy, but yeah, hit the easy button.
Payal, Mike's yours. Any unsolicited career advice?
Yeah, I'll give you a piece of advice that I got when I was young in my career. You have a day job and a night job. Your day job is doing the day-to-day stuff that you have on your plate, that you have to do for your boss, you have to do for your team, or you have to do for your role. Your night job is trying to figure out what you like and don't like, and networking with other people and actually offering time, not just saying, I'm interested in doing this. Is there a position open? Or, do you think this would be a good fit? Ask to actually contribute to a project. Ask to actually give your time and dedicate that to another group. Deliver on that project, and that will make you stand out.
We appreciate it, Payal and Jeremy. I did get couple questions in the chat. I'm just going to quickly touch on them. I don't want to ignore them. Barlow says, should we expect more states to pass regulations similar to North Carolina, banning certain entities from paying ransomware attacks? How does this impact the market? I'll just take this one really quick. You can't pay ransoms. There's obviously sanctions lists. So you can't pay ransoms to somebody on the sanctions list. And if I'm not mistaken, Evil Corp is on the sanctions list. So basically the whole concept there is, you can't pay ransoms to somebody that the government says it's illegal to pay a ransom to, right? Or do business with. How does this impact the market? The government has not outlawed paying a ransom just yet. This is a very touchy subject, right? Because you're basically having public policy dictate private decisions, right? So some of these companies, if you tell a company it's illegal to pay a ransom, but they still get attacked, and then their business is in jeopardy, and the easiest way to get out of it is pay a ransom, then you had you had the government make a decision for a private company. So it's we haven't seen that yet. It's hopefully it never happens. I think it's a very touchy subject. And then the next question I'll throw it to you too is, yeah, you may have touched on this, but going back to the war exclusion, does the industry distinguish between the political definitions of war? That is the difference between a formal declaration of war and so-called special military operations, applicable to the industry as a whole, but specifically to respect to cyber attacks going on from Russia. Jeremy, Payal, I think this one's a relatively easy one. Would either one of you want to take this? Jeremy?
I mean, to me, it all still comes back to the attribution in the end. I mean, you can call it a war, you can call it an event, you can call it an incident, a special military operation. The funny thing is, I don't think, Russia was original with that new term. I don't think Lloyd's, any of the phrases, definitions they threw out there earlier in the year included special military operation. So they might need to update their wording, but no matter what you call it, if there's a loss attributable to it, the attribution to a specific country for a warlike event is going to have to happen. So I think, again, attribution is what it's going to come down to. And who makes that determination? Is that a government making a statement? Can the insured make that statement? Can the insured make that? That's the end there.
I think one thing to add there is, if Russia does something to the US and, some might consider it war, some might consider it not, Russia might not particularly come out and say, hey, we took, we're the ones that did this, right? So I don't know if it's ever happened or not, but for example, the Russian government never took credit for it, but everyone knew where it came from. So then it's on the carriers and everyone to prove attribution. It's not an easy thing. It's definitely not black and white. So
even in that case, the U.S. and every other government came out and truly attributed. That's one of the few instances where the attribution was made to Russia.
Yeah.
But the two suits, not non-cyber, they were silent cyber. Merck and Mondelez are both looking like, the war exclusion's not going to hold on those.
Yeah. So that's you could talk for 3 hours about that one. So we'll end it there. Payal, Jeremy, thank you so much. Thank you, Marianne and Sarah, for helping put everything together here. We appreciate it. Should you guys have any questions or need anything or would like to get in touch with any of us, please feel free to reach out. I believe our contact information is on the flyer. If not, LinkedIn is relatively easy to get in touch with us. So thank you both for your time today, and we appreciate it.
Thank you.